Good. It's 2 minutes past the hour. Let's start. Hello and thank you for joining us for the launch webinar of our new guidance, Due Diligence towards Deforestation-Free Finance, Guidance for Financial Institutions. My name is Bruno Bischoff. I'm the head of ESG Risk Advisory at Ecofact, a small consultancy from Switzerland, and I'll be moderating today. We are very happy about the big interest in this webinar. Before we start, a couple of housekeeping points. This webinar will have simultaneous interpretation into English and Portuguese. As you see there at the bottom of the screen, you have a globe icon and which says interpretation, and there you can select the language in which you wish to hear the webinar. You won't need to change it afterwards once you have selected it. We have a Q&A box, so please post your questions to our speakers into the Q&A box, either in English or in Portuguese. We will have time for questions and answers in the second half of the webinar. Furthermore, for discussions and inputs from participants, the chat function is open, and in there we will also share key links for you to access. The webinar is being recorded in both English and Portuguese, and the recording will be shared afterwards. During the webinar today, we will hear from the following speakers. Pei Chi Wong. She's the Senior Research Associate at Global Canopy. Ben Levett, Lead ESG Researcher at Neural Alpha. And Silvia Chicarino, Environmental and Social Risk Superintendent at Santander, the bank. I'm happy that we are able to provide real-time translation as mentioned, and therefore we are grateful to our two interpreters, Louise and Chris. We have more people acting behind the scenes. Mark Titley from Global Canopy. He will be typing answers specifically to any of your more detailed questions on TRACE, the tool, TRACE methods and data sources. Moreover, we have Athena McCallum and Kate Rampersad, also from Global Canopy, who will operate the chat box and share links in there. So the due diligence guidance that we are discussing today was developed in collaboration by Global Canopy, Neural Alpha, and the Stockholm Environment Institute. The guidance has been published on the Deforestation-Free Finance portal, where you also can find the finance sector roadmap and other guidance pieces. During the consultation phase, feedback for the due diligence guidance was received from 10 finance sector organizations, which range from banks, insurers, asset managers, and networks, and also from 4 NGOs. The entire team working on the guidance is grateful for their time and comments. Now, I'd like to hand over to Pei Chi, who will give more detail on why deforestation due diligence is needed and how financial institutions can implement this brand new guidance, which, as said, has been launched today. Pei Chi, the floor is yours.
Thank you, Bruno. Good day to everyone. And if I could move the slides forward to slide 5, please. Next slide, please. So today I'll just be giving a brief introduction to why deforestation due diligence is needed, how financial institutions can implement such a process, and what actions they can take based on the outputs of the due diligence process. Next slide, please. I'll just get right into it. Next slide, please. So what is deforestation due diligence? We define it as the process of identifying, preventing, and mitigating deforestation exposure risk in a financial institution's lending and investment portfolios. So deforestation exposure risk is the probability that a commodity produced or sourced by a client or holding in your portfolio could be associated with deforestation, conversion, and associated human rights abuses. And of course, our definitions of deforestation, conversion, and associated human rights abuses are in line with what you can find in the finance sector roadmap and the accountability framework. These definitions are given in the guidance as well. Next slide, please. So there are several reasons, really, why financial institutions are addressing deforestation, but really the three of the main ones that I want to highlight today is that, first of all, preventing deforestation is vital to meeting climate and biodiversity targets and goals that many financial institutions have signed up to. Secondly, deforestation is a systemic risk. So it gives rise to physical and reputational risks that can then in turn impact the finance sector and its bottom line. And thirdly, upcoming regulations will require supply chain actors to conduct due diligence to ensure that their products will be deforestation-free. So next slide, please. Just talk a little bit about some of these incoming regulations. One of the most significant developments is the EU Deforestation Regulation, which the EU Parliament just voted to adopt by a resounding majority. And it's expected to apply from the end of 2024 for larger companies, with a slightly longer deadline for compliance by SME. So I would also highlight that the EU regulation imposes financial penalties on supply chain actors who are non-compliant. The law also mandates a review within 2 years as to the role of financial institutions in preventing financial flows contributing to deforestation, and whether there is a need to provide for specific obligations for financial institutions in EU legislation to tackle deforestation in supply chains. So this review is likely to be upcoming in mid-2025. And similar legislation is also in the pipeline in the UK and the US. So we go to the next slide, please. In our latest Forest 500 analysis published earlier this year, so really based on publicly disclosed policies and commitments, it was found that a large majority of companies who were exposed to deforestation risk were not prepared to be compliant with the new laws. So this is based on public information, and financial institutions may be in a position to then engage with clients or holdings to understand how they will be affected and how they intend to be compliant. But what it really shows is that in addition to all the other good reasons for financial institutions to act on deforestation, there's a really clear case for them to implement deforestation due diligence to really understand which of their clients or holdings are exposed to these deforestation exposure risks and what sort of policies and processes they have in place to manage these risks in order to comply with these new requirements. So next slide, please. How can financial institutions do that? So let's jump right in. Next slide, please. So in our guidance, we set out 2 decision trees that are a series of questions designed to elicit structured information about a company's operations and the policies in order to assess their exposure risk and policy risk. So the guidance then shows how a decision matrix can be used to combine the risk flags that are produced by these 2 decision trees respectively, and then combine these exposure and policy risk flags to form an overall deforestation risk flag. As you can see, we've put the decision matrix table in the slide. So the approach that our new guidance sets out is risk-based and uses increasingly granular information where it is needed and available to enable the user to assign a risk flag based on the least granular data available, because we understand the challenges surrounding this and the resource constraints that some organizations may face. So if we go to the next slide, an example of what that means is really right at the start of the exposure risk decision tree. So for example, in a case where a client or holding is operating in an industry that does not produce or does not source forest risk commodities, and of course, it has not been flagged up as being involved in known deforestation incident or breaches, it can be assigned a low deforestation risk flag based on that industry classification. And that means the user can then focus the data gathering resources on other clients or holdings that may be involved in higher risk activities and industries or sectors. So you could then focus on understanding whether the client or holding is producing or sourcing forest risk commodities, whether these commodities are produced or sourced in a country or a region known to be associated with deforestation, and finally, whether the client or the holding is able to demonstrate that they do not have assets or production sites located in known hotspots. And of course, this is the most granular level of data, and not all actors may have that, but we do recommend in the decision tree guidance how to deal with that. And of course, the Trace Finance due diligence dataset is here to also help users drill down into specifically traders' sourcing patterns at the subnational level for selected high-risk commodities and violence. So if we move to the next slide, talk a little bit about assessing deforestation policy risk. So where there's coverage, really, we see that financial institutions can already refer to datasets such as the Forest 500 that assess the most significant companies within supply chains for certain forest risk commodities. And there are other datasets available, such as SPOT, CDP, and so on. So now a financial institution that's looking to extend this policy risk assessment across the portfolio could also start by assessing whether companies operating in exposed industries have policies on deforestation and human rights. So really having deforestation policies and human rights policies is really a baseline, should be a baseline expectation. Now, where these are absent, the policy risk decision tree shows how a user can go through a series of questions. And so, of course, if it's a baseline expectation, if there's neither deforestation policy or human rights policy, and if there are certain conditions that indicate that the client or holding is exposed, then you could assign a high policy risk flag, which then indicates a key area for follow-up action. On the other hand, if these policies are in place, then the financial institution could then look at the strength of the deforestation commitment and the content of the human rights policy, and whether we have verified implementation reporting in place. We go to the next slide, please. So the decision tree methodology is generally developed based on best practice, and they are transparent and flexible. So you can really adjust based on your respective risk type and resources. And it does not replace a detailed assessment, but it does provide a systematic approach for financial institutions to identify where they can focus enhanced efforts to assess and mitigate risks. So if we go to the next slide, please. On that note, how can financial institutions use the results of that due diligence process to decide on what pre or post financing actions they can take? Next slide, please. So here we just have a quick recap of the phases of the finance sector roadmap. And in phase 3 and 4, financial institutions should engage clients or holdings that are exposed to deforestation risks and to disclose the progress that has been made during that engagement process. So in the pre and post financing actions that the guidance recommends, these are all aligned with these phases of roadmap. If you just go to the next slide, please, and I will really be rounding up soon. In particular, the guidance recommends that financial institutions engage and support clients to establish or strengthen their policies, improve supply chain traceability, and monitor progress with implementing these policies and processes. So the guidance suggests various concrete actions that have been taken to engage clients, and especially when not enough progress has been made, we suggest some options that equity owners can take to exercise ownership rights, for example, or in the case of lenders and debt holders, what sort of contractual requirements and incentives can be considered to incentivize stronger implementation of deforestation commitments. And really, in addition to all these actions, the guidance recommends establishing clear policies around these actions and publishing these policies so that you communicate these baseline expectations in respect of prospective clients or holdings. And that also helps to drive sector-wide change through the peer financial institutions. So really, finally, on the last slide, before I hand my time back to Bruno, here are 3 immediate steps we are asking you to take. So first of all, download the guidance at guidance.globalcanopy.org. Secondly, review the guidance and start looking at how you can implement and integrate the deforestation due diligence into your existing policies and processes. And finally, the Global Canopy team is ready to support you on this journey towards deforestation-free financial portfolios. So please reach out to us for a chat with me, and we'll be really happy to help. You can email us at guidance@globalcanopy.org. Thank you.
Thank you, Pei Chi, for introducing the guidance to us. Very interesting, and thank you also for keeping the time. We invite all participants, as the last slide said, to go through the guidance yourself at your own pace. And in case of questions or observations, please reach out to Global Canopy. The link was also posted in the Q&A box. And I'm grateful to Amy Fairbairn, also of Global Canopy, to have added the link. And we have a number of questions that have come in, so please continue submitting them into the Q&A box. Now we'll be turning to Ben from Neural Alpha, who is going to present on location-based analysis for due diligence. And maybe, Ben, if it fits, have a look at the first question, the question about identifying commodities to sourcing locations. Maybe you're speaking on that. Neural Alpha is a sustainable fintech consultancy and partner for this guidance, and it's also a partner for the supply chain and finance transparency tool Trace Finance, which hopefully many of you know. So Ben, please take us through your presentation.
Thanks, Bruno, and thanks everyone for joining us. Today I'm going to focus on running through a couple of hopefully useful concrete examples of actually applying the due diligence guidance to real life scenarios, focusing particularly on how Trace Finance datasets can be leveraged to give location-specific due diligence insights. Next slide, please. To pick up the thread from the guidance framework just discussed, this slide presents a more schematic outline of how an analyst might translate that across to a data-driven process. I'll touch on the profile and screen stages to show how they can ensure accurate coverage and streamline the process, but mainly spend time on the quantify and locate elements. Next slide, please. Trace Finance data provides a nested perspective of a trader's location risk, working down from the high-level country plus commodity level context metrics, through then to biome level risk, useful for mapping against bank exclusion policies and potential legislation risk, and then to subnational detailing that gives a far more granular and actionable assessment. Ideally, the final stage is then drilling down to asset level risk analysis. That needs care, particularly when modelling is involved, but we have prototype data already for Indonesian palm to this level and hope to extend to other contexts. This vocationally tiered approach to risk assessment is useful as it allows the analysts to stick to a consistent framework across all assessments, even if they have less initial data, for instance, for a company further down the supply chain. Next slide, please. So I won't dwell on this slide for too long, but this just gives a flavour for how trace finance information is structured to easily allow for joined up analysis using a set of bulk data files. We're kicking off some training sessions in May, so please do follow up if you're interested in trialling the data or having a more technical demo. Next slide, please. The first case study looks at due diligence on a trader loan. Next slide. Specifically, an investment bank is conducting due diligence on a proposed new trade finance term loan facility for our trader A. It wants to extend its know your customer analysis to deforestation risk before acting as lead arranger. This is actually an anonymized version of a real financing deal run by European banks. So it's a genuine example of how a good due diligence process could have been applied. Next slide, please. This slide runs through the not particularly glamorous profiling stage and highlights the key trace finance data sets needed for each job. First bringing together a selection of IDs and descriptive fields to confirm you're looking at the right organisation, as seen in the right-hand panel. And then in points 2 to 4, building up a full understanding of parent subsidiaries, as well as any off-book risk in external ventures. Next slide, please. Moving to screening, some of the high-level risk flags are shown here as a kind of traffic light dashboard, just to more visually illustrate this initial risk filtering stage, determining how much due diligence is required and where. You see how the trader needs assessing for Brazilian and Argentinian soy exposures as the main risk sectors, how it has exposure to key biomes in both locations, including the Amazon and Cerrado, as well as hotspots in those regions. That its parent is a large player in soy and that it does indeed have off-book exposure that needs exploring. On the plus side, it performed generally quite well for overall policy scores and for past risk markers such as fines. Next slide, please. Quantifying overall risk first and taking our cue from the screening, we see that the parent company has quite material deforestation risk for Brazil soy. But what really stands out is that the external joint venture flagged up earlier is exceptionally high risk at the top of the risk table, in fact. Next slide, please. Drilling down into that here, first we are picking out some of the locational analysis of the company itself. While there is material risk, it's not heavily concentrated in hotspots or soft commodity forum priority locations, for instance, hotspots being the small number of locations that disproportionately drive most of the national deforestation loss. In the right-hand panel, looking at how its export volumes break down into sourcing regions classified by degrees of deforestation risk, there's an element of very high-risk sourcing that can be explored with the company, but around 3/4 of sourcing is medium low to no risk. Next slide, please. Now looking at the external joint venture, the contrast is marked. Heavy deforestation risk almost entirely focused in the Cerrado and hotspot locations, suggesting that it's almost exclusively active in deforestation and frontier regions. Moreover, the analysis of volume shows that the vast majority is coming from highest risk sourcing location categories. As an aside, that also suggests from a pure financial perspective that revenue at risk for this holding is potentially quite high in terms of future legislation and blacklisting vulnerabilities. Next slide, please. So how does that translate into the decision? Clearly, the scale and characteristics of the external risk is a big red flag and could reasonably result in rejecting the loan involvement outright. But if not, and the view is taken that there is potential for impact involvement, then the concerns would have to be discussed with the trader and remedial action plan put in place. Proposing a shift to a genuine targeted sustainability linked note might be an option, for example. Next slide, please. For the second case study, I'm running through a more typical asset manager due diligence example. Next slide. As it says here, the asset manager is looking to bring a more structured TNFD style approach to the trade selection phase. In the interest of time, I'll just shortcut to the key takeaways of this company's screening results. The trader predominantly has major exposure and deforestation risk in Indonesian palm. It has a high level of complaints and it has some off-book exposure, as well as average policy reporting and commitment scores, which is a fairly poor rating. Our focus here on taking the locational risk assessment a step further and drilling into the asset level risk. Next slide, please. So this visual highlights the top 5 refineries and mills by deforestation risk linked to our traders' export flows, already starting to demonstrate how scrutiny can be focused down to the facility level. Next slide, please. This is a more complete picture of the mill risk breakdown, with maybe 10 to 15 mills providing the majority of the traders' known asset-linked risk. Next slide, please. And finally, this view shows how risk can be linked across assets in the supply chain, with deforestation risk by refineries on the inner circle linked to the main sourcing mills, generating that risk on the outer circle. This helps identify the elements of the supply chain risk that can be more easily challenged and tackled. Next slide, please. So in terms of the decision, again, there are some clear red flag issues. More than anything, the very significant deforestation risk footprint. You can see, though, how locational analysis could be invaluable in terms of providing some very concrete points of discussion and engagement with the trader. It should also be noted that our financial holdings data set shows that this trader is majority insider owned, that is by family and other trader equity holdings. This could make you question whether engagement and resolutions are likely to succeed, and so may argue against the case for an impact investment. I'll leave it there, and just a reminder that we're happy to trial data, run training sessions, and discuss any particular use cases. Thanks very much.
Thank you, Ben, for your insights into the more technical side of things and traceability, which I think you've proven showed a good proof case that actually data and methodologies exist to trace deforestation back to actors. Remember, again, if you have questions to our speakers today, post them into the Q&A box. You can do that both in English or in Portuguese. We'll make sure they will be translated. And behind the scenes, Mark will be typing responses on trace data and methods. Now I'm happy to introduce Silvia, who will be presenting on Santander's experience with engaging companies on deforestation. Silvia speaks to us from Brazil.
Good morning everyone, and thank you for this invitation and this opportunity to be here and share Santander's experience regarding engagement and to understand the wider theme of deforestation. It's important to understand before I start that our bank has a deforestation policy and working on different sectors, but then in particular, we address and analyze different commodities. And our policy also identifies high-risk geographies. So when we're doing our analysis, when we're dealing with a high deforestation risk area, our analysis has to be more detailed. And this policy also includes a number of bans. For example, we cannot engage in any projects, or we could not finance any activity or industry where they are, for example, categorized as IUCN categories 1 to 4, or, for example, World Heritage Sites or Ramsar sites. We're also prohibited from engaging with projects where there is extraction of native tropical timber. And also, we do not engage in projects related to development of peatlands. Now, considering our clients in Brazil, the first tool that we use to engage with the client is actually a questionnaire that we send our clients. And this questionnaire is not completed by us or by our trade team. Actually, it's sent to our clients. It's actually open. It's an open questionnaire. It's there available on our website, and it addresses different aspects: governance, environmental, social, and climate. And we talk about a number of different topics, including the actions and engagement with suppliers from a social and environmental perspective, and also water stress management, whether there's any degraded area or any area under embargo. So it's a very simple and direct questionnaire, but it provides us with a lot of information about whether or not we'll be able to engage with this client. After that, we also analyze the type of information that is actually publicized and published by the clients, their own reports aimed at their investors and the clients, and the kind of commitments that they make. We also carry a wider virtual due diligence process, analyzing government websites and licenses and any sanctions and any areas under embargo. And there are a number of different cases, of court cases, both from a social and an environmental perspective. And we also analyze media and news on the internet, and also NGO reports, and these are very important for us to be able, for example, to challenge clients' commitments. And we can also use geospatial tools for that. One of the tools that we use, and now I'll be talking about managing and analyzing corporate clients. One of the things that I pay a lot of attention to is Trace and Forest 500. Forest 500 helps me to understand the commitments that our clients make and how well they're doing in terms of implementing those commitments. And Trace is another tool that I've been using for many years, and I love it because it provides information about the whole chain. And for example, I use it a lot for soy, and I can understand the risks that are associated with deforestation areas. And it's a great tool because it enables me to establish a dialogue with our clients. So I'm not telling them that they did buy something from a deforested area, but I can tell them that they bought or they sourced their products from an area where there is deforestation risk. And this opens up a channel for communication, and it's all data-based, it's all based on data. Another tool that I use a lot when I want to challenge clients' commitments or question their commitments are actually NGO reports. And these reports give me a wider understanding from the perspective of civil society, how these commitments are being implemented and how they're being met. But of course, this is done through a conversation with my clients. I need to listen to my clients and understand how they are managing their business. So when we consider, for example, large corporations, they usually have well-established processes for that. But when I'm talking about retailers or small traders, this information that we get through our due diligence process, this is also a very good opportunity for us to exchange experiences. So I can show my clients what kind of tools I'm using for my work, what kind of information I am accessing. And for example, through a Trace, I can tell them, or I can ask them, okay, you're sourcing your products from that region. What kind of information do you have about that region in particular? And here, considering Brazilian producers, we can also exchange experiences about the kind of databases that we are using. And this is a very enriching exchange of information and experiences. And this enables us to make a very detailed analysis of risks in our portfolios. And after that, we have social, environmental, climate rating system, which goes from 1 to 5. And depending on the rating for social, environmental, for ESG, basically, of each client, it may have an impact on the final rating. And it could be both from a quantitative and a qualitative perspective. And this final report will be valid for 1 year. But of course, this will depend on the kind of information that we access to. So actually, the validity or the length of our rating will also be linked to the client's environmental licenses. So it could be less than a year. And based on that, we could also establish some conditions for credit. So we can decide not to engage in a long-term operation with the client, or perhaps establish a ceiling for the kind of credit that we're going to provide. And when we, for example, are talking with, let's say, smaller traders, I usually share with them what kind of information I am accessing and what I consider for my analysis. And here in Brazil, we have a lot of information available on, for example, indigenous lands and quilombola lands and archaeological sites and deforestation sites. And we use map biomas as a tool for that. And we also have government provided information, and both at federal level and at subnational level, and this helps us to identify risks. And these exchanges that we have of our clients, providing them information about where we get our data from. And this is just an example, just an illustration of what I'm saying. This is a situation of, we have this type of analysis. This is what our tool does. We identified that there was an embargo on a farm, and we could see that there was clearly there was a road connecting that area there on the left to the embargoed area. And we asked our client, about this and tried to understand what was happening there. And they told us that that area was under recovery, and we asked them to provide additional documentation if there was any agreement with the government. And we understood that the area was actually being used as pasture land, and it was being used for cattle ranching. And this is just an example of the kind of conversation that I have with my clients. So I start from a macro approach, trying to understand, their commitments and their flows, etc. And then I keep going down and zooming in at where I can actually share some of my personal and their personal experiences. And this is our day-to-day engagement with our clients. And basically that was it. That's what I wanted to share with you. And I apologize, perhaps I spoke a little longer than I was expected to, but I want to share some of my experience with you. Thank you.
That was very interesting and engaging. Thank you, Silvia. Obrigado. So very, very helpful. And we're in good time to have 20 minutes for questions and answers. And the questions have been streaming in both in the Q&A and in the chat box. So what I suggest is, in the order of the speakers as we had them, Pei Chi, then Ben, then Silvia, I will read out 2 questions for each of our speakers and let them answer them, and then go to the next speaker. It's questions selected from both the chat and the Q&A box. And so starting with Pei Chi, and these questions very much related to the guidance as it has been published now. Why was the focus on agri-food chains chosen? The argument is there are non-agri-food activities that also are often associated with deforestation. Examples given are mining, infrastructure like railways and highways and dams. So can you give an explanation for that, the focus?
Thanks, Bruno. Yeah, so I think it's really important to take note of these non-agri-food sectors as well, which is why, in the guidance, we also do indicate mining, infrastructure, and so on as some of the non-agricultural driven sectors that are associated with high risk of deforestation. So that is definitely something that requires more attention and more enhanced engagement and investigation. But we also do know that, agricultural expansion drives over 90% of deforestation worldwide, which is why many of the data sets that are out there are focusing on some of these specific contexts of agricultural production in these globally traded commodities and in these very regionalized production areas. So obviously the types of data sets that will be relevant and available are tailored more towards these contexts. But of course, it's very important to also make sure that deforestation hotspot and fronts, which are related to mining, infrastructure, real estate, and so on, are also being addressed.
Thank you, Pei Chi. Second question, just following up. There's a link being made to the EU Deforestation Regulation, EUDR, and it highlights that the EUDR is being criticized that it dismisses other biomes beyond primary forest. Is this also the case for the deforestation-free finance guidance, or are you covering broader biomes?
Yeah, so basically our guidance is very much aligned with the finance sector roadmap that was released around the time of COP26 together with the commitment letters. And also it's aligned with the definition of deforestation in the accountability framework. So definitely, it's meant to address all contexts where natural forest loss is occurring, as well as conversion of other natural ecosystems such as grasslands and so on. So I mean, I think it's clear that the EUDR is not perfect, but it also represents a huge opportunity where there's attention and investment being made in these processes and policies. So hopefully, once these are in place, it really means, it really does mean that once these are in place, we hope that means that it's really just incremental, marginal effort to be able to address the broader forms of deforestation and conversion as well.
Thanks, Pei Chi, very clear. Moving on to Ben, another question, making connections to other guidance or regulation. To what extent what we heard now with the guidance and what you presented, Ben, in your slides, how that differs to SBTi, AFI, the greenhouse gas protocols, and so on, or what the connections are maybe to these standards or guidance. Anything you can add on this?
I mean, I guess they all kind of follow a similar ethos and a similar type of framework, right? So the science-based targets for nature, for example, has a kind of similar kind of, I think they have it like a assess, interpret, measure, and act type framework, which is essentially, similar ethos to our framework, similar approach to TNFD, LEAP. They all have a similar conceptual approach to addressing the situation. And again, in terms of I think they adopt a quite similar kind of hierarchical approach to profiling risk down from like a sector level, then value chain hotspots they talk about, and then moving on to company level refinement. So it's a similar kind of approach. But I think in terms of the two things are completely consistent. So their metrics for targets are, I think it's like 0 deforestation by 2020, 0 conversion by 2030, and no net loss of natural habitat by 2020. So, which again is kind of consistent with the Accountability Framework Initiative. So they're kind of consistent with the same objectives we're pushing, and yeah, trace data is ideal as a sort of metric for measuring success or failure against that target.
Good, and taking you up on trace data, Mark has been very busy answering questions related to trace, but I do think one is still open, so I'm happy to share that with the audience. It's about the connection between midstream and downstream companies, how trace info can make this connection. A bit technical, whether this is done by weight or dollars, and whether it connects calculations of emissions. So anything you can say on that?
Yes. Sorry, did you say midstream to downstream?
That's what the question says. Yeah, but maybe you can span it wider up to including upstream, of course, the source.
Yeah. So at the moment, I mean, the trace data focuses on the middle of the supply chain, because that's where the flows kind of concentrate between, to the kind of its most traceable element of the supply chain, and also in the kind of more concentrated number of players. But in terms of then extending to downstream, like a lot of these things, it really depends context to context. So for example, for Indonesian palm, it's a lot easier because you can translate across the same kind of self-reporting analytics to like manufacturers and users. But for some other contexts, say where you're trying to trace, say, beef down to the retailer level, it's far less transparent, and then you're having to sort of like adopt some kind of like proxy metrics. So you're trying to use whatever information you have. So you might have some information about the kind of the breakdown of a particular downstream user's country sourcing, and then you have to kind of just adopt that to get a more kind of generic average basis of their risk, and then kind of take it from there. So I think there's a lot of work in terms of trying to model out that additional step further down the supply chain. And hopefully some of the new regulations we've got coming in like now will sort of like, as a kind of byproduct of that, will generate more reporting requirements, which will help everyone else then trace that linkage, sort of in a bit more of a concrete fashion.
Excellent, thank you, Ben. A very interesting question to Silvia, and Silvia, feel free to answer in Portuguese, it will be translated. The question is about client engagement, and how do you balance past negative exposure and future risk? You do engage with clients in the future, so that matters, but the question is how far into the future you are looking, whether this is just constrained to the engagement time with the client, or if this is going further out into the future.
A nossa, eu vou responder em português. Sorry, I will be answering it in Portuguese, okay?
So our analysis lasts around a year, which is what I mentioned in my presentation. And in this period, when we are sort of doing this analysis, then I can engage in many different operations with the client, but then operations related to a specific project, then I need to analyze the project to understand the associated risk to that project. But the financing, such as cash flow, capital, a sort of credit line without a specific use of proceeds sort of credit line, as it were, during the validity of our sort of opinion, if you will, we can engage in all sorts of operations. However, if we identify some sort of restriction because of my analysis, and we look very much into the past, the news, what has happened, as it were, but also with the data, the commitment, understanding whether or not that client is implementing the commitments. I saw that there was a specific question on certification. If this client has any certification, for instance, I take all of this into account. If I have, access to the result of this certification report. So, we having access to this information, this makes it easier. It makes me much more comfortable to be able to assume commitments for the future. So the deadline does depend on the type of financing that I'm doing. And if we understand that there is something that we're doing where we are not allowed to assume long-term risk, this is pointed out in our report, and this is shared with the bank's credit area. So this is already part of our decision-making process.
Great. The other question to you, Silvia, picks up a term that Pei Chi actually mentioned initially. She recommended banks to think about issuing sustainability-linked loans or bonds. But here to the practitioner from Santander, whether such information about deforestation has already been used by Santander to structure sustainability-linked loans or bonds. For example, where the kind of improvement that is agreed with the client is any improvement in deforestation-related performance indicators.
Yes, we consider in our green deals, as they're called. So everything starts by assessing the companies, okay? So then if we have one that has a low result, that we understand the sort of risk appetite, they are not even subjected to green financing activity. So when we have a green financing operation, we are going to understand what are the KPIs established and whether or not they're relevant. So we have a internal sort of forum where we discuss the operations. They all go through this forum, okay? So, of course, we're improving the whole sort of governance as time sort of goes by, but we do take these aspects into consideration of our processes for our green financing sort of deals. And then when we issue our report, we can point out this company, this project, we do not recommend for green finance because of this, because of that, because of course the green financing offers you some benefits,
Yeah, very helpful. Thank you. One question we can take, maybe another one after that. It's about balancing the needs of more information that the bank or financial institution has with balancing the needs and maybe constraints of a client or investee company. So the question is about, on the one hand, if a bank or investor requests more data, more technology, and more traceability for commodities, if this could not come at the cost of reducing access to capital to smaller producers who are overburdened by having to provide to their clients up the value chain such specific information. And maybe we can have a view from Pei Chi, or maybe from all of you, starting with Pei Chi, then with Ben, and Silvia's view from her position.
Yeah, thank you. That's a really great question. And so that is really why when we talk about the associated human rights abusers, one of the internationally recognized human rights that needs to be protected in supply chain actors' policies is really the labor rights through the entire supply chain. And that also really includes smallholders within the supply chain. So for example, whether the company offers support to smallholder producers to help them to enter these responsible supply chains or to achieve compliance with these commitments is very important. And that is one of the metrics, one of the indicators that is assessed in the Forest 500 methodology. So agree that that's really very important to take note of as well. And I would also note that really traceability is a collective problem that requires a collective solution. So it doesn't really make sense for everybody to be investing in separate traceability solutions that don't talk to each other, which is why it's really crucial for that collective engagement from financial institutions to be able to put, for example, all the supply chain actors for a particular value chain in the same room, in the same conversation, so that we can achieve that, efficiency in terms of the traceability solution.
Very clear. Does Ben, Silvia want to add anything?
No, I think that's a great point. I think the other thing I'd add is that there's kind of quite a lot of new stuff happening in kind of like microfinance, where there's people investigating like traders providing finance to producers on the basis of this having this greater traceability, if you like. So I think that can be a win-win, and some people are seeing that as a kind of a more promising avenue for green finance than the kind of more macro scale sustainability bonds that we're seeing. But I mean, Silvia might know a bit more about that kind of small level financing.
Good, excellent. Thank you, Ben. I think it seems we could go on for another half hour and throw questions at our speakers and would get excellent responses as we have, but we have to bring it to a close. Thank you very much, participants, audience, for joining us in this webinar today, for your excellent questions. In particular, many thanks to our speakers, Pei Chi, Ben, and Silvia, for your presentations and fielding these questions, giving us food for thought. Big thanks for the important and good work that our interpreters did behind the scenes. We have seen the new guidance is available under the link just indicated, and please download it, utilize it. Currently, the languages are English and Brazilian Portuguese. In about 2 weeks, it will also be published in Indonesian Bahasa, another very important region for that topic. Don't hesitate to send questions to our colleagues from Global Canopy with the email indicated, and shortly after the webinar, the recording will be shared in English and in Portuguese in the next few days. Finally, you will receive an invitation to complete a short survey, so we'd be very grateful if you could do so. But for now, have a nice afternoon, a good day. Thank you. Obrigado. Bye-bye.